How's it going, everybody? This is Beat the Bush. For those of you young people out there that just started a job, you're likely starting to look at how you should invest your money. A lot of young people have the wrong question in mind. It's not what you should exactly buy in your portfolio, but the mentality behind it. Yes, of course, there are certain ticker symbols that you should pay attention to, but what matters most is your long-term behavior if you're going to buy or sell at the exact wrong times. So today I'm going to go over some scenarios, sort of train you to be more well prepared whenever something bad happens in the market so that you don't make the wrong move. Now, right off top, if you look long enough in these financial independence type of articles, most of the time they would point you to low-cost index fund. You should buy into low-cost index funds. So if you just go online, look up S&P 500 low-cost index funds, you're likely going to find a handful of very low-cost index funds. What is low cost? Something around 0.04% or below. Sometimes people who work at a bank has a lower low cost when they buy into a certain index. For example, if they work for that particular bank for Fidelity or something, you can get as low as 0.03%. So don't be surprised that if it can get a little bit lower than 0.04. But for anyone that's not working for a bank, if you're just working for some company, then you can indeed just go out there and buy this very, very low cost fund. Why do you want a low cost index fund? Because just a 0.01% in fees can add up to be something very, very big. So you want this fee to be as low as possible, and you don't look at it in terms of 1% or 2%. 0.01% is a big deal. Now, because of various investing rules, I cannot point you to a specific ticker symbol because this is just against the law. I can get in trouble for recommending a very particular type of stock. I can say what I personally buy, but I can't tell you guys, hey, if you're a young person, you should invest in this particular ticker symbol. So that's why in this video, I am not saying exactly what it is, but it's very easy to find. So just go look for it and then you'll know what to buy. So what is the most important thing with investing? It's not me telling you what fund to buy. Let's say you have $10,000 and you go open up a brokerage fund and then you go and pour all your money into, these index funds. Okay, great and all. But the more important thing with this whole thing is that you do not waver when the market goes down. This, as I was telling a young guy at my gathering in Fremont, because he was asking, oh, how am I supposed to invest? I just started work for 2 years. You have some sum of money. How can he invest so that he would get reasonable gains over the long period? The most important thing to realize is what kind of investor you are. If you're just starting out, you don't know yourself how you are going to react when the market goes down. Let's say you have $10,000 and that's like your life savings, and then you poured it all into a low-cost index fund, and then you watched it drop 10%. Another 10%, another month, and like maybe 8 months in, you saw your whole portfolio of $10,000 drop all the way to $5,000. You got to imagine, how are you going to react? Most people will not know how they're going to react. And most of the time, when you are surrounded by gloomy people, they're like, oh, the sky is falling. And not just a particular day, okay? This is a sustained long period of gloomy period where you see on the news every single day, oh, the S&P 500 dropped another 5%, and you just keep on seeing this. People that they're saying, oh yeah, you know what, I'm just had it. I finally sold everything. I'm not dealing with just watching my portfolio go down. You have to realize at this instance, after such a long period of doom and gloom, are you personally gonna sell out? And history says that most people actually do sell. People tend to sell at the wrong time, and by the time the market recovers enough, you're already too late to buy back in. I personally have seen it myself. You really actually have to live through, for example, the dot-com bust in 2001, as well as the housing bubble popping. You have to really live through it to see the craze that leads up to it, and then the doom and gloom that comes after that. The duration is real because once you're surrounded by so many people that's so enthusiastic for a long period of time, you actually tend to buy into it. You are living in it versus what you think you're going to react is a lot different. So as a new investor where you've never lived through a downturn, it's really hard to say how you're going to react. So I can tell you how you're supposed to react and all. What you're supposed to do is just keep on dollar cost averaging into it. If you have $10,000 and then you're only bringing in, let's say $1,000 more into the investment account, you might want to spread it out over, I don't know, 10 months or 1 year. So the first buy is only $1,000 or something. And so you keep on buying until maybe 1 year later, then you finally are fully invested into it. This is dollar cost averaging. Then even during a downturn, you keep on buying into it. This is what you're supposed to do. This is what many people sort of know that you're supposed to do, but then a lot of people actually do not follow this. So your biggest concern as a young investor is to know what you're supposed to do and actually do it. Now, for you young investors out there, one of the more important things to avoid is the trading fee. A lot of times, if you just go get some random brokerage account, it might charge you something like $9.99, $7.99 for each single trade. So it does matter where you open up your account so that you can actually do your monthly buy-in for free. This is especially important for dollar cost averaging because you don't want to go, oh, every single time you buy, let's say $100, you have to pay $10 worth of trading fees. So the important thing is to get one of the free brokerage accounts, which is Robinhood or M1 Finance, or if you have more than $50,000 of investable assets, you can open up a Bank of America Merrill Edge brokerage account, and in that case you can also get some free trades that way. Now, if you guys are interested in supporting this channel, you can open up a free Robinhood account and you can get free trades that way. And if you open up through my referral link, you can get a free stock. They say you can get something like an Apple stock or a Facebook stock, but those things are like $100 some, so you definitely have a very low chance of getting it. In my experience, I got something like $4 or $5 value, some, stock like that. So most likely the free stock that you're going to get, it's going to be somewhere between $3 and $5. Alternatively, there's more and more companies that offer free trades, including an app called M1 Finance. This app, which is pretty new, it also offers free trades. So if you want to support this channel, check out my referral link down in the video description below for M1 Finance. Recently, we saw the S&P drop a lot, and the sound investor, what you're supposed to do in this situation is not really care, even if you have a lot of investable assets in there. Maybe 100% of your investable portfolio is totally into stocks. You should just go, whatever, which is basically what I'm doing. I don't really care if it goes down 5%, 10%. The way I look at it is that, oh, great, 5%, 10% down. Okay, let me just buy some more if it happens to be that time of the month where you're buying into it again. So in fact, if it drops by another 10%, 20%, 30%, then I'll be like, oh my gosh, this is like a steal of a lifetime. Then I'm totally gonna, put more and more cash in it. It's gonna be like a fire sale. So once you buy into it, then you're like, oh yeah, wait a year or something, and then you're essentially gonna make double because, after a few years, it kind of bounces back. So why should you believe that it will actually bounce back even? Because maybe there is some doom and gloom situation where the price of the stock is just going to go down to zero. The idea here is that the companies that's behind the S&P 500, it's worth something, right? They're always going to be generating some amount of profit. And basically what they generate is how they are going to be valued in some way, depending on each company's PE ratio. Of course, if you think it's gonna go to zero, it's basically a doom and gloom situation. So how many % chance is America gonna fall down to zero? It's gonna be like an Armageddon where, the financial network just completely melts down. Well, there is a small chance of that happening. How big a chance do you attribute to it? It's basically when you think that economy is gonna collapse, then yeah, well, maybe you should sell it and buy gold then. But the chances of that happening, you have to measure for yourself. How big a chance will that be? Some people say when you use a fiat currency, it never lasted for more than a few hundred years. For most intensive purposes, if the economy goes down, you probably have a lot more to worry about than just your assets going to zero. People are going to be out on the streets. It's going to be, no laws or something. You likely need more guns than actually cash in your bank in that type of situation. So thanks for watching this video. I hope you young investors out there kind of get like a brief overview of what you're supposed to do. If you're interested in supporting this channel, check out those referral links for those apps that I referred to in this video. Don't forget to push that subscribe button and ring that bell icon. Thanks for watching.